Welcome back to our intermediate financial accounting class. We've been talking about the accounting cycle and all the different elements that are part of it. We've talked about what makes up the cycle, why it's important, what the accounting equations are, why we use them, and how we decide whether accounts are debits or credits. And then we get to start doing journal entries. And it was a blast, wasn't it? Now we get to continue on with our discussion of journal entries. And then we'll get to talk about a little bit more of the accounting cycle. What I'd like you to do is take a look at this journal entry. And we're going to do the same thing we've done in the other examples. Before you try this, here's the journal entry that we did before. We sold merchandise on account, we recorded a debit to accounts receivable of $25,000, and we offered them a 3% discount if they paid within 10 days. Anything beyond 10 days, well, for that, they'll have to pay full price. So here we are in this example. They've paid half of it within the 10-day period on day 9. The rest of it they paid later. And we're going to go ahead and assume that they get the discount on any portion that they pay within the 10 days. So go ahead, make these two journal entries. Let's take a look at day 9. Let's see, we know we're getting cash in, but we're not sure how much yet. We know accounts receivable is dropping, and accounts receivable is going to drop by half. So let's see, $25,000 divided by 2, $12,500. That's what's coming out of our accounts receivable. But they're not going to pay all of that because they paid within the 10-day window. We're going to take the amount that is owed times 1 minus the discount percentage. So $12,500 times 1 minus 0.03, 3%, is going to give us 12,500 times 0.97, finally 12,125. That's the cash we're actually going to get. Now, you'll notice this doesn't balance, and I hate that. It's going to make my hands start twitching here if we're not quick. So we need $375 debit to make sure our debits and our credits are equal. So again, we need an account. Remember, this was a discount because of a sale that we made. So we're going to call this sales discount. We're so clever, aren't we, when we come up with titles? This is received payment of 1/2 of account in the discount window. Next, we have the payment on day 15, and in this case they're paying the other half, but now they don't get a discount. So we're going to debit cash by $12,500, credit accounts receivable $12,500, received payment of 1/2 of account. Let's go ahead and take a look at this like we've done before. Assets equals liabilities plus equity. What happens? Well, let's see. We get cash of $12,125. So that goes up. Then we credit accounts receivable, $12,500, so that asset goes down, and now we don't balance. Well, we have that other debit for $375 to sales discounts. Well, sales discounts are a contra revenue. They reduce our revenues. Now, revenues, if you remember, are part of equity. If a revenue goes down, or a sales discount goes up, that's a better way to say it. Sales discount goes up, it's a contra revenue, so it's got the opposite balance of a normal revenue. So that means that as it gets debited, equity goes down. That account gets bigger, we have less. It's on that left side of that equity breakout. So we stay in balance because equity dropped a little bit to show that we didn't get as much from those customers. There you go. We didn't get as much from our customers as we thought we were going to get. So we recorded too much revenue in the beginning. Okay, we stay in balance. For the other one, well, that one's a lot easier. We get cash of $12,500, accounts receivable goes down $12,500, and I stay in balance. Let's take a look at another journal entry. This time the owner withdrew money for personal use. Take a second, do the journal entry. You ready to go through it? So in this case, we have some kind of a withdrawal. If this is a corporation, then we're going to debit dividends. If it's a sole proprietorship or partnership, then it's usually named after the owner and given a clever name. Owner's withdrawal. And since they withdrew $5,000, our cash is going down. Withdrawal by owner. Really straightforward. Maybe we don't need to do this for you anymore, but just to make sure we're consistent. Cash goes down, equity goes down, stay in balance, just like that. One last journal entry. Kind of a bummer, but don't worry, there's lots of other entries to come. But this is the last in this example. Paid for advertising in the local newspaper, $250. Go ahead, make the journal entry. Let's go through it together. So paid for advertising, let's see, clever accounting names, advertising expense, perfect. Credit cash, because I paid for it, whoop, $250. $250 paid for advertising. And that's it. That's all there is to it. Last time we get to do this, so let's make sure, well, we might slip it in a couple more times just for fun. But last time we're really going to do this consistently. So let's see, cash goes down, I paid $250. Okay. Let's see, advertising expense gets debited. We debit an expense. The higher an expense goes, the less equity we have because the owners get less, so we drop. And that's the way we stay in balance. Assets go down, equity goes down, and we stay in balance. That's the end of our journal entries, which means it's time to go on to the next step of the accounting cycle. Now, if you remember the picture, we started with identifying the transactions. Then we moved over and did the journal entries. Next, step 3 over here is posting those journal entries. And that's what we see next. If you remember, posting means that we take the information from the financial statements and we put it into the ledger. So again, we've got this bookkeeping warehouse where we've gathered all of the different information about the company. We've got different windows that we're letting people see through, and we take that information and we're going to put it into our ledger. So some kind of a T account, like accounts receivable or cash. Now, the good news is that most computer programs nowadays do the posting for you. So you actually don't do this very often anymore. We're going to do a little bit of it just so you can see how it works. But like I said, good news is most of the time this is being done for us because it's a very long, time-consuming process. I remember doing this by hand. Back when I started learning, there weren't computers that did this for you. You had to do this all by hand. And boy, you had this process down. For now, I just want to make sure you know how it works. So let's take a look again at that journal entry that we just did. We debited advertising expense for $250. We credited cash. If I were going to post this, what I would do, first off, is I'd put a date on there. So let's say, let's use like the 4th of July. So July 4th, we paid for advertising. Why we were in the office, I don't know, but we were. So you have to have a date in order to post effectively. The next thing you're going to do, you're going to go to your ledger, which is a list of accounts, and you're going to find the advertising expense account, and it's going to have a number associated with it. And usually expenses start with a 5. Assets are the 1s, liabilities are the 2s, equity are the 3s, revenues are the 4s, expenses 5s, gains and losses are 6 and 7. It's just the usual breakdown. So here's what we're going to do. So we're going to take this number, $250 debit, and we're going to put it down here in our advertising expense account, and I'm going to label it with the date so that I can find it again if I have to. Then I'm going to come back to the journal and put the account number here. So this number here and the date there show me that I have posted this entry. Then I go to the next line item, and that's cash. So I would go to my ledger and I would find the cash account, which is usually, again, 1s for assets. Cash usually comes first, so 100. And let's see, I credited cash, so I'm going to credit for $250. There's my date again, and I'm going to come back here and put in that 100. And again, this number and this date show that I have posted these entries. We just did this for one entry, but you can imagine that this could very quickly and easily become a very tedious process. Imagine doing this for a whole day's worth of entries, or a week's worth, or a month's worth, or a quarter's worth, or a year's worth, all of these different entries having to come out of the journal and go into the ledger one account at a time. Good news again, most computers do this for us. It makes it really straightforward. But if you have to do it by hand, it's doable. It just takes a long time. Now, the next step in our accounting cycle is to do a trial balance. But before we can do a trial balance, we have to total out all of these accounts and get an ending balance in each one. So to do that, really a straightforward process, but you have to kind of get the hang of it by doing it a couple of times. So, basic equation is simple. We start by looking at what was in the account at the beginning of the period. Then we add whatever we added to the account. We subtract whatever we've withdrawn from the account, and then we're able to calculate that ending balance. We can also use this equation in other ways. Sometimes we'll know, hey, I want to end up with this balance. What kind of a journal entry do I need to get to go from where I'm at to this ending balance? So I can calculate the subtractions. Or I want to know, how much did I buy over the course of the period because there was a fire and I lost all my data? I know how much inventory I had on hand at the beginning of the period. I know how much inventory I've sold, and I know how much I still have. I can figure out what did I buy. So you need to be comfortable enough with this, familiar enough with this equation that you can find the beginning balance if you have the other three, you can find what you took out with the other three, you can get the ending balance with the other three. You need to be that comfortable with this equation because we use it all the time in different transactions and estimates and values that we have to do. So let's go ahead and play around with this. We're going to do 4 different examples and let you see how this works. Let's do the first one together. So at the beginning of the period, we had $10,000 worth of inventory. During the period, we purchased an additional $100,000 and we sold $105,000. We want to know the ending inventory balance. And this is what you would do normally as part of the accounting cycle, just getting to the end of the cycle and creating this ending balance to use in your trial balance. So there's 2 ways you can do this, and it depends on you. Most of us who are accountants prefer to see a T account. So we would come in here, let's see, inventory is an asset. So if I started with 10,000, that would be a debit. I bought another 100, that would be a credit. Or excuse me, that would I wrote it right, I just said it wrong. That would also be a debit. The 105 that I sold, that would have come out of inventory as a credit, and now I can solve. $5,000 is my ending balance. So those who are accountants, we like to see it this way. A lot of other people don't like it this way. They prefer to see an equation, and that's doable as well. So if you prefer the equation looks like this. We take our beginning balance, and you remember we had a generic equation, plus additions minus subtractions equals ending. We're going to change the wording here. In this case, what we add are our purchases, what we subtract are our sales, and that will give us our ending balance. So let's see, beginning balance is 10,000, purchases 100,000, sales 105 gives us our ending of 5,000. And you'll notice either way we have the exact same answer. Now, it doesn't matter which of these you use. Whatever one makes the most sense is the one you should use for you, right? Because they both give you the exact same value, so it really doesn't matter. I will warn you though, if you're an accountant, most people expect you to be good with T accounts. So if you are an accountant, you might want to take the time now, make sure you're comfortable with that T account version. If not, then it doesn't matter. Use whatever you're most comfortable with. Now let's take a look at a couple more examples that do this a little differently. Same basic idea, but now we've got different numbers coming. So here's the first one. At the beginning of the month of December, we had $250,000 of accounts receivable. At the end, we have $200,000. Our credit sales, or the additions to accounts receivable, were $1.5 million. We want to know how much we were paid. Go ahead and take a second, give that a try, and then we'll come back and talk about it. If we're going to do the T account, here's our accounts receivable. We started with $250,000. We sold on account $1,500,000. And we ended, it says, with $200,000. I've got my comma in the wrong place. There we go. That's better. So I want to know this number. Or I can set it up as an equation. So let's see, my beginning balance plus credit sales Again, you'll notice I'm changing out that term. Minus my collections equals my ending balance. So in this case, I know the 250. I know the 1,500,000. I don't know that number, but I do know that I ended with 200,000. Either way gets you the same answer, $1,550,000. So that's our second example. Let's take a look at another one. This time, we're going to look at retained earnings. So retained earnings started with $35,000. During the period, the owner withdrew $45,900. At the end, we had $54,000 in there. So we want to know what was net income. That's what gets added into retained earnings. Go ahead, give it a try. Okay, are you ready? Retained earnings. This is an equity account, so it actually has a credit balance. So we started with $35,000. Owner withdrew $45,900. We ended with $54,000. I want to know this number. If you prefer the equation, beginning balance plus net income minus our withdrawals equals our ending balance. So let's see. 35,000. I don't know that number. I'm looking for it. And we end with 54. And again, either way, we're going to end up with the same value, 64,900. All right, our last example here of account balances. This one's a loan. We know that at the end of the year, we got a piece of paper from the bank. You owe us $150,000. We know during the year that interest accrued of $20,000, and we know that we made a total payment of $70,000. We want to know what the beginning balance was. Loan payable. Let's see. We don't know this number yet. We know that we end up at $150,000. Let's see. Loan payable, liability. Okay, so that's a credit. Let's see. We added the interest. We would take out the payment. So that's what we're looking for. If we use the equation, our beginning balance plus the interest minus the payments equals our ending balance. So let's see, ending balance is 150. Payments were 70. Interest was 20. So there's X, and I can solve for that. Either way, I started with a balance of $200,000. How did you do? Were you able to follow along on all four of those and feel comfortable with the process? I hope so. It really is a key concept to be able to use this equation to get all the different balances or all the different values. The beginning balance, the ending balance, what you added, what you subtracted, whatever it is you need to be comfortable either using the T account or the equation to get these numbers. We use it all the time in all sorts of different accounting things, so it really is key understanding how to do this. Okay, with that said, we're going to wrap this up for now. We'll be back later to continue on with our discussion of the trial balance and the rest of the steps in the accounting cycle. And the fun just goes on and on. I'm excited. We'll see you then.